Whether you're a newcomer to Canada or a longtime resident, understanding how the Canadian tax system works is an essential part of your personal finances. So in today's video, we'll break down the basics to understanding how taxes work in Canada for different types of income, along with covering many tips and tricks to demystify this often complicated topic so that you can navigate the Canadian tax landscape with confidence. By the way, my name is Griffin, and over the years, I've had many different jobs, businesses, income sources, and various investments. So I've had to learn as much as I could about the Canadian tax system as well, even though I do work with a professional CPA each year for filing my corporate and now personal taxes as well, which I would always recommend if you have a situation a little bit more complex than just income from only say one or two sources like a job. Let's start off with understanding the basics of how income taxes work in Canada for working individuals, as this is the category that 95% of you will fall into if you have a job that pays you a salary. So at its core, Canada has what's known as a progressive income tax system, which essentially means that the more money you earn, the higher the percentage of your income you will be contributing in taxes, both at the federal level as well as the provincial level. And in theory, this is designed to ensure a more fair and equal distribution of the tax burden across Canadian citizens. To do this, your income is divided into what's known as different tax brackets, each with its own tax rate, which will differ from one province to another. So as you earn more income and it moves up through the income tax brackets, portions of that income will be taxed at a different marginal rate, falling into your highest tax bracket, which is known as your marginal tax rate. Now, as of 2023, the Canadian federal tax rates look like so. On the first $53,359 of your income, you would pay a tax rate of 15%. On the next $53,358 up to $106,717 of your income, you would pay a tax rate of 20.5%, and this continues up until $235,675, where any dollar generated above this value is taxed at 33%. Now, there are a couple of things to unpack here. First of all, let's remember that these tax rates are only for the federal portion of your income tax. So the same marginal tax system works within each province, but rates and values will differ from each other. Second, it's important to note that the tax rates we just covered only apply to the income earned in each one of these tax brackets, where the tax rate only applies to the portion of income generated within that tax bracket. For example, if you earn $60,000 this year, this would mean that your income falls in the second federal tax bracket, where you'll be paying 15% on the first $53,359 of income for an amount paid of $8,003.85, because we've entirely filled up this tax bracket, and the remaining $6,641 of earned income above the previous tax bracket would be taxed at a marginal tax rate of 20.5%, meaning $1,361.41 of tax paid on that amount. So in total, we'd be looking at paying around $9,365 of federal income tax on a salary of $60,000, giving an average tax rate of 15.61%, which isn't super important. It just gives you a sense of the percentage of your total income you paid in taxes. What's more important is the marginal tax rate that you're paying, because while earning income in a given tax bracket, each extra dollar earned will be taxed at that rate. So in this previous example, at 20.5%, this means each extra dollar earned, you're left with 79.5 cents on that dollar. And this is up until this tax bracket is fully maxed out, at which point our marginal tax rate would increase to the next bracket. Now, what about if you make $110,000 in the year? Well, again, the first $53,359 would entirely fill up that first tax bracket and would be taxed at a rate of 15%. Then the next $53,358 will also entirely fill up that next tax bracket and therefore be fully taxed at 20.5%. And the remaining income above the top value of the previous tax bracket of only $3,200 $1,283 in excess there would be taxed at a marginal rate of 26% for a total in federal taxes paid of $19,795, not $28,600, which would be 26% of the total $110,000 of income. It is really a marginal rate on those progressive amounts as you go up through the tax brackets. Now, in this example, from the $110,000 of gross income, after paying your federal income tax, you would be left with a net income of $90,205, giving you an average tax rate of 17.99%. Let's also keep in mind that this is only for the federal tax portion and ignores the provincial income tax that will also be required to be paid on that earned income, where again, each province has distinct tax brackets and rates that don't entirely line up with the federal ones. So calculating this by hand can be a little bit tricky, which is where an online tax calculator can become pretty handy if you're looking to estimate your taxes owing for the year. Let's take a look at that right now. All right, so there are a handful of these tax calculators available online that will work just fine, but the one I generally use is Wealthsimple Taxes Calculator, as it's pretty straightforward to use and to understand. I'll leave a link down below in the video's description, by the way, in case you're interested. It's totally free to use and I'm not associated with it in any way. It just works pretty well. So you'll start off by selecting the province that you'll be paying your taxes in, let's say Ontario in this case, and then from there you're presented with various input fields such as employment income, RRSP deductions, capital gains, and so forth. But we'll start off with simply inputting $60,000 into the employment field for this example, as this is the example that we looked over previously. And right off the bat, the right box will be updated, showing us federal tax owing, provincial tax owing, CPP premiums, and then also the average and marginal tax rate. So in this case, the total tax to be paid would be $13,798, of which the federal portion would be $6,228. And if you're wondering why this value is quite a bit lower than in the $60,000 example that we just looked over previously, this is in part due to the personal tax credit that reduces the tax liability for every Canadian, which we'll talk about later when covering tax deductions. And there are some other factors such as the Canadian pension plan contributions that will also impact the federal tax owing amount. But yeah, these online tax calculators can be a great way to estimate how much tax you'll owe at the end of the calendar year based on employment income, self-employment income, dividends, capital gains, and so on that you might know you'll be reporting on your tax return. Now that we have a better understanding of the basics around Canadian taxation, I'd like to take a moment to cover the various types of income that most of you will be subject to now and at some point throughout your life, as each of these are taxed differently. So we'll start off with regular employment income, generally referred to as T4 income, which is what you'll earn when working a job, as your employer will provide you with a T4 tax slip that you use to file your tax return. And employment income happens to be the highest taxed form of income that you can earn in Canada, as it is fully taxed based on the marginal tax rates and brackets that we just looked over earlier. So if you're only earning employment income, you will be paying the highest level of relative tax, which is in contrast to, say, capital gains and dividend income taxes. So that's why you should definitely strive to build an investment portfolio to create more than one single income stream for yourself. Unfortunately, though, most Canadians do 100% rely on a job as their primary and only source of income, which is taxed the heaviest. Okay, now before we speak about investment income, let's cover self-employment income, as many of you may well have started a little side business over the past couple of years, and in the CRA's eyes, self-employment income from a sole proprietorship, meaning not a corporation where you would have incorporated your side hustle or little business, is taxed the same way as employment income in regarding to the tax rates, as net income from your business is added to your total taxable income. The main difference with self-employment income is that you can now utilize tax deductions from earning that income to lower your tax burden. Moving into investment income, this is where the tax code allows for more favorable tax rates, including capital gains and dividend income. So let's start with capital gains. When you sell an asset such as stocks, real estate, or any other investment, and the proceeds exceed the original purchase price, the profit is considered a capital gain. And the unique aspect about capital gains taxation lies in the fact that only 50% of the capital gain in question is included in your taxable income, which effectively means that you are only taxed on half of the profit, reducing the overall tax burden. So in the same $60,000 example from earlier, if we added to that, say $10,000 in capital gains because you did well on a stock, well, only $5,000 is actually added to your taxable income, meaning you'd only be paying around $1,482 in additional tax on that $10,000 capital gain. Additionally, what's interesting about this is that Canada allows individuals to offset capital gains by applying any capital losses that they may have incurred in the same tax year or by having carried them forward from losses in previous years. So there are some ways to strategize paying less income tax. And finally, dividend income from any investment is also taxed quite favorably over employment income. Here's an example to illustrate this reality. So in the same $60,000 employment income scenario, earning an additional $15,000 in dividends for the year would only result in an additional $1,108 of tax, whereas a $15,000 pay increase, say, at your job would result in an additional $4,924 of tax, which is a very big difference. So although it does always make more sense to make more money, even though the marginal tax rate does increase, it's also strategic to utilize tax-sheltered investment accounts such as the TFSA and RRSP to offset your tax liability even further than it is through investment income in the first place. And by the way, I have many videos on my channel that cover these very topics, so make sure to check them out if you want to learn more. Additionally, if you are currently working a job, it could make sense to try creating some business income where tax deductions can significantly reduce your total taxable income and therefore your tax liability for the year, which brings us to the next section of today's video. You can use what are known as tax credits and tax deductions to lower your taxable income and liability. A tax credit is a direct reduction in the amount of income tax owed by individuals or businesses. And unlike tax deductions, tax credits subtract directly from the total tax liability, offering a dollar-for-dollar reduction in taxes owed. So this means that regardless of how much income is made from one individual to another, a tax credit will be equal in regards to how much tax is saved. By the way, there is also what's known as refundable and non-refundable tax credits. Non-refundable tax credits, such as those generally for education or charitable donations, can reduce the amount of income tax owed to zero, but do not result in a refund if the tax credit exceeds the tax liability. Whereas refundable tax credits can not only reduce taxes owed to zero, but also trigger a refund if the credit surpasses the total tax liability. For example, if your tax owing was $2,000 this year, well, a non-refundable tax credit of say $2,500 would fully bring your taxes owing to zero, but would stop there. Whereas a refundable tax credit in the same amount, $2,500, would bring your taxes owing to zero, but then also trigger an additional $500 surplus that is paid back to you. Now, although most tax credits apply to lower income earners and households, there are a handful of tax credits that everyone can apply to, including the following. We have the personal tax credit. That is a non-refundable tax credit that allows individuals to earn a certain amount of income each year without paying federal income tax on it. We also have donations to charity, certain medical expenses can be tax credits, interest paid on student loans, the first-time home buyer tax credit up to $1,500, and a few more. On the other hand, a tax deduction is an expense or allowance subtracted from an individual's or business's total income to determine taxable income. So unlike tax credits that directly reduce the amount of taxes owed, deductions simply lower the taxable income in the first place upon which the tax liability is calculated at your marginal tax rate. In contrast to individuals, for businesses, tax deductions can include most things that are paid for to create income. So let's say rent, marketing expenses, legal fees, costs of goods, and so forth, whereas tax deductions for individuals with a job are often less common, but there are a few depending on your situation. One of the most popular Canadian tax deductions includes contributions to your RRSP, where the amount of your contribution is deducted from total taxable income, therefore lowering how much tax will be paid. Here's another example. So if your taxable income is $60,000, but you make a contribution to your RRSP in the amount of $10,000, well, you're now only going to be paying tax on $50,000, which happens to be a $2,749 tax saving. What's great about tax deductions such as RRSP contributions is that you can often strategize them to bring your taxable income right down into a lower marginal tax bracket, therefore paying less overall tax, which is especially true for very high income earners that are in those hefty tax brackets, which is why sitting down and strategizing when to use your RRSP contributions really makes sense if you know that, say, in a couple of years, you might be getting a significant pay increase. It would make sense to hold off on those contributions to pay less relative tax down the line. And here are some of the most common tax deductions for Canadian individuals and Canadian businesses that allow you to lower your tax liability. As you can see, they differ quite a bit. To summarize, the more money you make, the more you pay in income tax on a marginal basis, but there are ways to be more tax efficient, offset said taxes, and reduce tax entirely. Thanks a lot for watching today's video. If it provided you with value, please leave a thumbs up, comment, and subscribe. It really helps me grow the channel. And don't miss out on this video to learn more about the quickest and cheapest ways to file your taxes in Canada. Take care, see you in the next one.